There are games where you bankrupt a company, and then there are games where you bankrupt a nation. You do not trade stocks. You do not care about quarterly earnings. You look at a sovereign country, millions of people waking up, working, saving, completely unaware that their entire financial reality is built on a mathematical lie. A lie their government is desperately paying billions to maintain. You find the crack in their central bank, and you push until the dam breaks. In a single night, a lifetime of their savings becomes worthless paper, while your offshore accounts swell by 10 figures. It is the most ruthless trade in finance. If you want to understand how the global financial machine truly devours the weak, subscribe to this channel and watch closely. You sit in a corner office in Mayfair, staring at a cluster of monitors. You are not looking at charts of moving averages. You are looking at the balance sheet of an emerging market central bank. The country is growing, the politicians are smiling, but the math is bleeding. They have pegged their local currency to the US dollar to import cheap goods and project stability. Stability is an expensive illusion. To keep the currency from falling, their central bank has to sell dollars from its foreign exchange reserves and buy its own currency every single day. They are fighting the free market, and the free market is relentless. You open a massive spreadsheet. You calculate their current account deficit. You cross-reference it with their short-term external debt obligations. The numbers tell a very clear story of quiet desperation. They claim to have $40 billion in foreign reserves. You know perfectly well that at least $15 billion of that is entirely illiquid. They are burning through $2 billion a month just to keep the artificial peg alive. The broader market does not see it yet. The local citizens definitely do not see it. They are still depositing their paychecks, planning their futures, believing their money holds permanent value. You see a dying animal pretending to be perfectly healthy? The government is subsidizing imports, artificially inflating the purchasing power of its own people. It is a political choice, not an economic reality. When economics and politics collide, economics always wins the war. The timeline is rapidly closing. You estimate they have less than 10 months of viable reserves left before they run out of dollars completely. Once they run out of dollars, they cannot defend the peg. The currency will inevitably freefall. The politicians will blame speculators. They will blame foreign interference. They will blame everything except their own flawed mathematical equations. You do not care about their political excuses. You only care about the mathematics of their collapse. You take a slow sip of cold black coffee. The scent of blood is in the water. It is time to start building the trap. Building a macro position of this magnitude requires absolute silence. If the central bank realizes you are accumulating a massive short position against their currency, they will preemptively strike. They will restrict capital flows or manipulate overnight borrowing rates to squeeze you out before you even begin. So, you move like a ghost through the international banking system. You do not execute trades on public exchanges. You go directly to the prime brokerage desks of major international investment banks in London, Tokyo, and New York. You structure complex, over-the-counter forward contracts. You are essentially agreeing to sell billions of the local currency for US dollars at today's artificially high exchange rate, with delivery set for 6 months in the future. The international banks are happy to take the other side of the trade. They collect a modest premium, entirely oblivious to the catastrophic systemic failure you are mathematically anticipating. You also begin borrowing the physical local currency. You borrow it quietly, in staggered tranches of 50 million, then 100 million, carefully spread across a dozen different counterparties. You use your existing dollar assets as collateral. You are hoarding their currency, piling it up in the digital vaults of offshore entities. The goal is to amass a war chest so overwhelmingly massive that when you finally unleash it onto the open market, the central bank will not have enough foreign reserves to absorb the impact. You spend 4 months doing nothing but accumulating ammunition in the dark. Your analysts track the borrowing costs daily. The negative carry, the cost of simply holding this massive short position, is quietly bleeding your fund by hundreds of thousands of dollars and their living single week. Your investors do not know the specifics of the trade. They only see a slight drag on quarterly performance. You do not panic. You understand that paying the premium is just the cost of admission to a financial slaughter. You are meticulously setting up dominoes in a pitch-black room. The local government continues to issue reassuring press releases about their robust economic growth. The finance minister gives a passionate speech declaring the currency is fundamentally strong. You casually read the transcript of his speech while executing another $500 million forward contract against his country. Your position size abruptly crosses the $4 billion mark. You have enough leverage to severely damage them. But a true sovereign kill is rarely a solo endeavor. You cannot break a sovereign central bank entirely on your own. You need the collective weight of the market. You need the wolf pack. The financial world is small, and apex predators recognize each other. You do not send emails. You do not make phone calls that can be recorded by compliance officers. You arrange a private dinner at an exclusive club in London. You invite 3 portfolio managers from competing macro hedge funds. These are men who control tens of billions of dollars in deployable capital. You sit down, you order expensive wine. You do not discuss the target directly at first. You talk about global liquidity. You talk about emerging market vulnerabilities. Then, you casually slide a single, unmarked printed sheet of paper across the table. It contains the true, unvarnished calculation of the target country's liquid foreign reserves. The math is undeniable. The men look at the paper. They look at you. No explicit agreements are made. Collusion is illegal, but aligned incentives are simply the nature of the market. They understand exactly what you are showing them. You have found the bleeding vulnerability, and you are inviting them to join the hunt. Over the next 3 weeks, the market dynamics begin to shift imperceptibly. You watch the prime broker data. You see massive, quiet borrowing of the target currency originating from entities you recognize. The pack is assembling. They are building their own short positions, layering billions upon billions of pressure against the fragile peg. The central bank is now unknowingly facing a combined short interest that rivals its entire usable dollar reserves. The local financial press remains blissfully ignorant. They report on infrastructure projects and ribbon-cutting ceremonies. You sit in your office, watching the collective short position grow to $12 billion. The tension in your trading room is palpable. Your analysts are quiet. Everyone is waiting for the catalyst. The central bank is still defending the peg, burning through their reserves at an accelerating rate just to absorb the subtle mounting pressure from the pack. They think they are dealing with normal trade fluctuations. They have no idea they are surrounded by apex predators coordinating a synchronized strike. You wait for the exact right moment. You need the central bank to be at its weakest, perhaps right after a major external debt payment clears. You check the sovereign debt calendar. A $1.5 billion bond payment is due next Tuesday. Their reserves will dip below the critical psychological threshold. That is when you will strike. The trap is fully set. The wolves are starving, and the prey is completely blind. You are ready to initiate the final sequence of destruction. Tuesday morning arrives. The sovereign bond payment clears the international clearinghouse. The target central bank has officially transferred $1.5 billion out of their dwindling reserves. They are mathematically exhausted. You walk into your trading room and nod at your lead execution trader. It is time to draw first blood. You do not ease into the market. You drop a hammer. You instruct your desk to aggressively dump $2 billion worth of the borrowed local currency directly onto the spot market in a single, violent wave. The foreign exchange screens flash violently. Market makers recoil in shock at the sudden, overwhelming volume. To maintain the artificial peg, the central bank has no choice but to step in immediately. They are forced to buy their own currency, burning through hundreds of millions of real US dollars in a matter of minutes. The illusion of stability begins to fracture openly. Panic sets in at the Ministry of Finance. Bureaucrats are frantically calling international banks, trying to understand the source of the avalanche. They realize they cannot absorb this level of selling pressure with their remaining reserves alone. They must deploy their most destructive defensive weapon. Before the London trading session closes, the central bank makes an emergency, unscheduled announcement. They aggressively hike the overnight interest rate to an unprecedented 50%. Their logic is desperate but predictable. By making the cost of borrowing their currency astronomically high, they hope to squeeze the short sellers and force them to abandon their positions. It is a textbook defense mechanism, but it is a fatal mistake. You watch the rate hike announcement and smile coldly. You already borrowed your currency months ago at rock-bottom rates. Their defensive maneuver does not hurt you at all. Instead, the 50% interest rate instantly paralyzes their own domestic economy. Local businesses cannot afford to roll over their short-term debt. Mortgages become unpayable overnight. Credit freezes entirely. More importantly, the extreme rate hike is a glaring signal of pure desperation broadcast to the entire global financial system. The central bank has essentially fired a flare into the dark sky, declaring to the world that they are rapidly losing control. The local stock market violently crashes in response to the tightening credit conditions. The citizens wake up to a sudden, inexplicable financial panic. The first bleed is successful. You have forced the government to attack its own people to protect a dying currency. The rest of the global macro community immediately notices the blood in the water. Other hedge funds, institutional investors, and multinational corporations operating inside the country realize the peg is critically vulnerable. They begin rapidly liquidating their local holdings to avoid the impending devaluation. The avalanche has started. The hesitation is gone. The entire market understands the dynamic now. You do not wait for the central bank to recover from their disastrous rate hike. You signal your desk to unleash the remaining capital. You begin aggressively dumping another $3 billion of the local currency into the spot market. Simultaneously, the wolf pack descends. The 3 portfolio managers you dined with in London execute their own massive sell orders. Within 48 hours, a synchronized avalanche of over $15 billion in short selling pressure hits the fragile central bank. The foreign exchange screens are bleeding red. The bid-ask spreads blow out completely as market makers refuse to catch the falling knife. The central bank intervenes frantically. Their reserves are draining at a terrifying velocity. They are burning through $1 billion an hour just to keep the exchange rate artificially suspended. You watch their usable dollar reserves evaporate in real time on your terminal. It is a mathematical certainty playing out at light speed. They are pouring buckets of water into a collapsing dam. Inside the country, absolute chaos erupts. Corporate treasurers realize the currency is doomed. They rush to the banks to convert their remaining local cash into hard dollars at any cost, exacerbating the violent downward spiral. The central bank governor makes desperate calls to the International Monetary Fund, begging for an emergency liquidity line. The IMF demands strict austerity measures that the current political regime cannot possibly survive. The negotiations stall. There is no external savior coming. By Thursday afternoon, the central bank's trading desk simply stops answering the phone. They have officially run out of deployable foreign exchange reserves. They are completely out of ammunition. The government realizes they have lost the war, but politicians cannot admit defeat silently. The Prime Minister appears on national television for an emergency broadcast. He looks visibly exhausted and sweating under the studio lights. He delivers a passionate, angry speech. He tells his citizens that the banking system is secure. He assures the nation that the currency remains fundamentally robust. He forcefully condemns greedy foreign speculators and international shadow forces for attacking their sovereignty. He guarantees that the government will never abandon the peg. You sit back in your leather chair and watch the broadcast with the volume turned down low. You have seen this exact political theater play out in a dozen different emerging markets over your career. You know the golden rule of macro currency speculation. The louder a politician screams that a currency will not be devalued, the closer the devaluation actually is. His televised guarantee is the final confirmation. They have absolutely nothing left to fight with except empty political rhetoric. The mathematical reality is about to crush their political fiction. You instruct your traders to hold all positions and prepare for the final collapse. Friday morning arrives with a deafening silence. The market opens, but the central bank is entirely absent from the order books. At 8:15 local time, a 2-sentence press release is quietly published on the Ministry of Finance website. Effective immediately, the central bank will no longer intervene in the foreign exchange market. The currency is officially allowed to float. The peg is dead. The surrender is absolute. Within the first 3 seconds of trading, the currency gaps down 20%. By noon, it is down 45% against the dollar. The mathematical reality they tried to hide for years is instantly, violently priced into the open market. You watch the terminal as the destruction unfolds. The massive short position you built in the dark over 6 months is now generating astronomical returns. You borrowed billions of their local currency when it was artificially expensive. Now, you must simply buy it back to repay those initial loans. Because the currency has completely collapsed, you are buying it back for pennies on the dollar. You systematically close out the forward contracts and spot positions. The difference between what you sold it for and what you are buying it back for is pure, unadulterated profit. The trade nets your fund over $2.8 billion in realized gains. The other members of the wolf pack take down similar numbers. It is one of the most profitable days in the history of global macro speculation. But the flashing green numbers on your screen are directly tied to the grim reality on the ground. Inside the shattered country, the hyperinflation sequence instantly begins. Imported fuel prices double by the afternoon. Pharmacies run out of basic medicines because they can no longer afford to import them. Supermarket shelves are stripped bare as desperate citizens panic buy basic necessities before their paper money loses even more purchasing power. People stand in lines stretching around the block at empty automated teller machines. The middle class is mathematically eradicated in a single trading session. Lifetimes of hard work, secure pensions, and family savings accounts are vaporized by the sudden devaluation. You do not look at the photos of the riots on the news wires. You do not read the stories about bankrupt families or collapsing local businesses. You cannot afford to attach human sentiment to macroeconomic realities. You tell yourself that if you did not break the peg, the laws of economics would have broken it eventually anyway. You simply accelerated the inevitable and monetized their political incompetence. You did exactly what the global financial system demands. You found the structural inefficiency, and you ruthlessly exploited it until it shattered. Your execution desk finishes unwinding the final positions, just as the sun begins to set in London. The trading floor remains dead silent. There is no cheering. There is no celebration. You quietly lock your terminal. You close the spreadsheet. You take a final sip of cold coffee. You look at the world map hanging on your office wall. There are over 190 countries on that map. You begin looking for the next fragile central bank. The ultimate lesson here is brutally simple. When political ambition tries to artificially suppress economic reality, the free market will always violently correct the lie. You cannot legislate mathematics. Looking forward, as global debt continues to accelerate and central banks exhaust their desperate defensive mechanisms, more emerging markets will inevitably attempt to hide their structural decay. The predators are already running the calculations for the next sovereign kill. A new collapse is not merely a possibility, it is an absolute mathematical certainty. So, who really controls the destiny of a dying nation? Is it the elected government or the silent men sitting behind trading terminals in London? I want you to think about your own financial security. What would you actually do if your entire life savings lost half of its purchasing power in a single, devastating afternoon? Have you ever witnessed the fallout of a severe currency crisis firsthand? Drop your thoughts, strategies, and personal experiences in the comments section below. If you want to continue understanding exactly how the dark global financial machine operates behind closed doors, hit the subscribe button, turn on the notification bell, and share this video with someone who urgently needs to wake up.